And one of those big sectors for that broadening out trade has been the energy sector, right? One of those value sectors overall. So Wall Street does at least appear to be pleased with President-elect Trump's pick for Treasury Secretary, hedge fund manager Scott Bessent. He's an advocate for that so-called 3-3-3 target, a plan to cut the deficit by 3% by 2028, achieve 3% economic growth, and then add 3 million new barrels of oil per day to production. So what could that mean for some of the oil giants, perhaps like Halliburton? Our next guest is here to share that strategy. Joining us now is Mike Khouw, the chief strategist over at OpenInterest.PRO. Mike, we talk about the energy trade often because it is part of this so-called Trump trade. What exactly is attractive to you about oilfield services and specifically Halliburton, and why this trade?
Well, I mean, if we take a look at, Scott Bessent's sort of plan, that 3-3-3 that you were just talking about, that's a pretty material increase in U.S. production. Now, I would just quickly point out that, we're already at the highest production that we've ever seen in the United States. I mean, we're producing well more than 20 million barrels a day equivalent right now. We're the largest producer on the planet. And, of course, if oil prices continue to stagnate or go lower, it's hard to see how the industry is really going to want to basically get aggressive to increase production under those circumstances. But if you are going to see an increase of about 15% or so, then obviously that's going to increase demand for oil field services. Halliburton is, as you point out, one of the largest. I mean, in the United States, we've got Schlumberger is number one, Halliburton's number two. Halliburton has more exposure to, North American land oil services specifically, and obviously you'd need to see some big increases there to achieve Bessent's objectives.
Okay, so what exactly then is the trade? If we're looking at this particular oil site, this whole construct for it, what exactly do you do with this particular action?
Yeah, so one of the things we've obviously seen is that right after the election, the whole space got quite a big pop. So if you take a look at where names like Halliburton were trading just prior to the election and where they are now, we've obviously seen a little bit of a rally. So I think the idea here is that if you're going to try to make a bullish bet, you probably don't want to take immediate exposure at this level. So I was looking at buying a longer dated call, such as an at-the-money call going out as far as April, let's say. That would be a 32-strike call. And then, because I doubt a whole lot more is going to happen between now and the inauguration, looking at selling some near-dated premium against it to help offset the decay. So you could, for example, sell a December 34 strangle. That would be selling the downside puts at the 30 strike and then selling the upside calls. Now, that would mean that, of course, you have some risk of being put the stock. That is, that you would own the stock at 30. But, that's getting closer to where the stock was pre-election rather than where it is trading right now. So this is a way where you can essentially get some upside exposure, offset some of that decay. And if you are put the stock, you're going to own it at the pre-election price rather than the higher price where it's currently trading.
All right. Mike Khouw with the trade there on Halliburton Oil Services. Thank you very much. We'll see you soon, sir.